last chance to get out here on this rally, okay? And it's been strong, and that only favors people that still have stocks or real estate and still been holding on. Okay, this is last chance. And yes, even if we make a slight new high on the S&P, that's 10% or so upside. The upside is limited now, and the downside has just gotten larger than ever.
In today's video, Harry Dent, author of 0 Hour, talks about what's up with bonds, the next moves of the Fed, the raging inflation and the coming recession. Dent has been predicting a great reset of the biggest financial asset bubble in history. The market historian predicted a painful crash in stocks and an economic depression, and discusses the next moves before the big crash. He believes that the top is in and the Fed is tightening aggressively. Could the markets make a new high?
Reading a clip from Jim Rogers. For people who know him, you know, he's been around a long time, shorter guy, but really kind of like one of those sages that always comes and brings reality, especially at extreme times of high and low. And you know, his article and his statement was very simple and very much in line with what I'm seeing. He says, we're about to see the worst crash in my lifetime. And he's as old as almost any of us and a little older than me. Okay, so, and I think that is the simplicity. And just look at it. The last major generational low was in 1981-82. It actually hit in stocks in late 82 and the economy in 83, before the greatest boom in history launched with the baby boom. So that was the end of the Bob Hope boom. Okay, since then, what has happened? We had a very the mildest recession was the one in late 99, early 91. 20% stock crash, nothing burger. And then, the tech wreck hit, especially the NASDAQ, not the S&P quite as hard, but NASDAQ was down 78% in good times. And when demographic trends, even by my projections, were still very positive for a good ways to go. And then, of course, we had the most recent major downturn. Stocks peaked in late 2007, bottomed early 2009. Economy and housing didn't really come out of it until early 2012. That was the worst recession and downturn in most of our lifetimes. And it was worse than 1973 to 75. And only in unemployment was it not as bad as 81, 82. Okay, so now, I mean, that's just the natural assumption, especially with governments constantly, since 2009, just printing money and more money, never letting the economy take a rest, never letting the economy deleverage bad debts and knock out zombie companies, all the things that keep the economy healthy, you know? So everything's going in the wrong direction while the stock market goes straight up. And now this rally, oh my God, you know, since late last year, after that first crash, and you know, I'm saying that was an important moment. I had to research every stock market bubble and boom and crash in all of history back 2 centuries to see what differentiated, what finally said that a bubble was over. And it really did mean you had to have about a 30 to 50% crash. And so that's what we got, 38% on the NASDAQ, 28% on the S&P 500. I wish it would have been a little more the S&P, but that's finally told me that this bubble looks like it's finally over, despite all the endless stimulus. And again, I keep warning and telling this simple story. What happened? The Fed's been pushing this thing since 2009, fighting recessions at all costs, like that's good policy, which it is not. We've had a good recession every decade, and if we hadn't, we wouldn't be nearly as rich as we are over the last century, okay? But that's what's happened. They've been pushing, but then they finally overreacted to COVID. That's what I've been stressing lately. COVID was a natural thing to happen. Nobody would think there's something wrong with the economy if we slowed for a couple years while everybody was sick, okay, and getting this virus and everything slowing down a bit. But no, they doubled down. The biggest stimulus, 5 trillion fiscal, 5 trillion monetary in history. And now we're in this key moment. I'm telling you, this is really a very tough tipping point here. we're still benefiting from that unbelievable, unprecedented, greatest stimulus in history in 2 years, that overreaction to COVID. That is still hitting kind of 12 to 18 months later on this lag. But we also know, because they loosened so much there, which was an error, I think it's going to go down in history. They overreacted. They were forced to tighten, okay, starting in March of last year, 2022. Now that's going to hit over 12 months plus, okay? It's really going to hit this, and this is the biggest tightening we've seen all the way back to the early 80s, okay? The biggest one. 500 basis points with another 50 almost locked in, expected by the markets in the next 2 months, okay? That's a huge tightening, and it takes 12 to 18 months to hit. So we are just should start hitting this around now, and we should see the biggest impact of this tightening into around the summer of next year, okay? So we got more coming. So what are the markets doing after making stupendous new highs in the greatest second bubble in history? And again, let me remind again, we've never seen 2 major stock bubbles in a row and 2 major real estate bubbles in a row. The first 2, stocks peaking, tech bubble in early 2000, and the real estate bubble that followed it when speculation suddenly shifted to real estate, all the crazy investors, okay? That was a natural bubble. Ever since, now we've seen the biggest and the most and totally artificial bubble in history, created only by money printing, not by fundamental demand and demographics, which I measure better than anybody in the world and all around the world. And it's slowing everywhere in the developed world, okay? So they've been fighting this, and I think this could be the point. Now, there is no way to measure this perfectly with the market. I mean, these markets are so perverted and confused. I'm telling you, most of the time, my view is the markets know when they're going. They're driven by the smarter money that have better information and go against the crowd. They know where they're going, but they fake before they go there, because they want to shake out all the dumb money and give it all back to the smart money, okay? Well, I think even the markets are confused at this point. They've been stimulated so long, and the fact that the markets would get within 8% of the S&P 500 all-time high in this period when they're tightening, one of the strongest in history, that just doesn't make sense to even be shooting for new highs. And I do not think we're going to make new highs. The S&P 500 is 11% away today, but the NASDAQ is still a little over 20%, and the Russell 2000 small caps are a little over 30%. So even if even the most bullish scenario that the S&P goes up another 10% or so and just barely makes a new high, the NASDAQ's not going to come close, and the Russell 2000 is not going to come anywhere near close. And then you're going to have another huge divergence, which also screams, again, major long-term top, okay? So we've had all the divergences. And really, the only solution here that I see that makes any sense in this whole perverted, unprecedented scenario of all time, okay, is for the markets right about here to finally slip and fall fast enough after this very strong and undeserved rally, and fall fast enough to stay ahead of the Fed before the Fed can reverse from tightening to loosening again. And you just don't go. Rarely. Everybody's expecting, the markets are expecting, or elite pundits on CNBC are expecting the Fed to, okay, they're tightening here, then they're going to suddenly loosen. No, that's not what they do. You tighten, you pause, then you stimulate again if it's warranted. I'm saying by the time they do that, the fundamentals are so weak underneath in demographics and long-term trends, and not for long, by the way, but they're still in that weak baby bust stage, okay, of the downturn, okay, that this is the time when we could have this third wave crash step in and go down enough to lose the confidence of investors and scare them enough so that they don't just come running back and shoot for new highs because the Federal Reserve says, well, we're going to print 10 trillion next time instead of 5, and here's the new fiscal stimulus plan and all this stuff, okay? That the Fed gets caught with their pants down here. So I'm still betting on that scenario. Last chance to get out here on this rally, okay? And it's been strong, and that only favors people that still have stocks or real estate and still been holding on. Okay, this is last chance. And yes, even if we make a slight new high on the S&P, that's 10% or so upside. The upside is limited now, and the downside has just gotten larger than ever. And remember, you look at the charts, and the charts tell the truth more than anything, especially in a time like this. The only real strong support for the markets are all the way down, just a couple years back, by the way, to the early 2020 lows, the COVID crash lows. That is going to be down 50% or more from here, and 60%-ish from the all-time highs. That's what I think is coming next. No guarantee on this, and Jim Rogers said the same thing, but this is the natural logic. Governments and central banks are fighting the broader, smarter, more pervasive economy that operates by Adam Smith's principle, the invisible hand. The only smart, visionary economist truly in history. He was really the first great economist. He said it perfectly. That's how, if you set them up right and take the shackles off, that's how markets work. If you let them work to their own best and sort out the difficulties and get rid of the bad companies and push more new and lift the good companies. I'm saying this is the most likely point I see. And again, there's no way to call this perfectly. There is no way, especially when a market's been pushed this hard, this confused, this perverted, this overstimulated. But I say this could be the point where the momentum just starts to tip back over, and then the market runs away from the Federal Reserve and central banks around the world just long enough, does just enough damage to consumer confidence, market confidence, and reveals the underlying economy as weak as it actually is. And then it's hard to recover from that. We have a bounce from that, but and then we could see this whole thing over by late 2024. And then again, this is another something, my best theory at this point, for a long time, I've always said this downturn should have come from early 2008 into early 2023 or so. Those markets should have peaked in 2007, which they did. I called that way in advance, and then they should bottom around late 2022. My best look now is that all this stimulus and pushing has just shifted forward that ultimate long-term baby bust, lull in spending bottom, and bubbles finally deleveraging, and they always deleverage hard. They never deleverage slow and soft. There's no soft landing off a bubble. That hits about 2 years later. Instead of mid to late 2022, we see the long-term bottom mid to late 2024. And with the top finally, and that first 38% crash in the NASDAQ to verify as well as you can, starting right in late 2021 and the S&P 500, January 4th, 2022, that sets up a perfect 2.5 to 3 year crash into mid to late 2024. But what has to happen now and soon? This bounce has to stop. Okay, it's already gone farther than it should, farther than it's deserved by any metric, any logic. And this bounce should start to turn down soon. So again, if you're still holding on to stocks, get out now. You can always get back in. And again, it might be 10% higher at worst, okay? And even then you'd wait for a pullback. This is a great time to get out if you're not. And let's give the market just a month or two here to show that it can actually start to crack and turn down again. And I think once it does, it's going to gain momentum. And that would be the second test. If we do go back down and test the late 2021 low, 2022 low, between October and December in different months. If we do go back and test that, this time we should push through it and go through it a lot harder, okay? That'll be the sign that we're in this final downturn, and it is going to be enough to detox the economy and allow us to get back to normal and allow the millennial generation, a lot of our kids, the whole next generation, to have a boom that they deserve that is not compromised by us keeping our debts from the baby boom into their generation's economy. That'll be the most unfair thing that happens in history. That boom will clearly be compromised if we do not allow the bad debts and zombie companies to be cleared out here in the next few years.